Hey everybody, Alex Lozano here, your favorite financial planner, back with another timely tax update. So I'm sure everybody remembers the 2017 Tax Cuts and Jobs Act. Let's talk about what that was. So it helped boost investment in businesses, it simplified tax filing, it cut taxes for households across the income spectrum. Now, that Tax Cuts and Jobs Act is set to sunset, otherwise end at the end of 2025. So in 2026, your taxes are going to look much, much different if this provision expires, if Congress doesn't act to either extend it or make some of these things permanent. Now, you might think to yourself, well, 2026, well, that's still a little bit far away. But some of the provisions that were enacted by this Tax Cuts and Jobs Act were very, very important and made a big impact when it comes to financial planning, wealth transfer, but also your annual tax deductibility and tax preparing. So, what did the Tax Cuts and Jobs Act do for individuals? Well, it eliminated the personal exemptions for taxpayers, and it also increased the standard deduction and the child tax credit. So some of those were kind of offsetting each other. It also changed some of the itemized deductions and how AMT is calculated. That's alternative minimum tax, meaning it really just made less people subject to it. So if you are a business owner or if you receive a lot of equity compensation from your job, when some of these things change back to the former calculations, it could mean that you could be subject to AMT much easier, like in the past. So, what did it do for businesses? If this expires for businesses, it's going to expire the ability to expense business investing, such as R&D. It's going to eliminate the 20% deduction for some certain business income, the deductibility of employer paid meals. If you're an employee, I know that makes a big impact for you. Other things that it did for businesses, it also gives businesses credit for family and medical leave. But one of the biggest impacts that it had when it comes to financial planning and wealth transfer is it modified the estate deduction. So it doubled the estate exemption in 2017. This year, the estate exemption is 14.3 million. Now, when that sunsets, it's going to revert to about half. Talk about that in just a second. So, what happens when this sunsets? Let's think through some of the effective changes that are going to happen to the individual. So, your tax brackets and the ranges are going to go back up to where they were prior to 2017. Everything adjusted for inflation, but they are going back up. The standard deduction that about 90% of taxpayers use is going to be cut in half from $15,000 today to around $8,000. The personal exemptions are going to come back of around $5,000. But that just means that it's going to be more on the taxpayer to try to figure out what their tax liability is going to be. It's going to make it a little harder. The child tax credit phase out, income limits are going to be reduced, so less people are going to get this credit. And one of the more controversial changes that the Taxes and Jobs Act enacted was the limiting of state and local tax deduction. Today, you're limited to $10,000 of property tax, income tax, or sales tax that the individual pays. If this does sunset, it's going to be uncapped. So you'll be able to take full deduction of all of those expenses. Another minor change for homesteads is it would increase the deductibility of some of these loans from 750,000 up to a million. And then also some of the miscellaneous deductions were going to be restored. Again, one of those things that's just going to make it a little bit harder for the taxpayer to calculate an accurate and simple tax return. Also, I mentioned AMT. AMTs would revert back to its original calculation, meaning more people would be subject to it. One of the last things I mentioned earlier, the estate tax exemption that today is $14.3 million would be cut around in half to $7 million. You might think to yourself, wow, that's really big. That's not something that I have to worry about. But you'd be surprised. I've run a lot of financial plans where normal individuals, middle income individuals, save well for retirement and don't spend too much. They can have multiple $1 million left over at the end of their plan. I'm talking from $3 to $5 to $7 million. Now, that just means that they're going to be subject to a state tax, another tax that you have to look out for. Don't get me wrong, it's a good problem to have, just an additional headache for taxpayers and people to have to worry about when you're thinking about transferring wealth to the next generation and setting them up for success. So these are some of the changes that could happen. Again, they're set to start expiring at the end of 2025, all the way out until 2028. But it's good to start thinking about these because it's going to make a big impact on how you do your taxes. And for businesses, if you're a business owner, the ability to deduct certain things, and it's going to make it more complicated to file your taxes again. So we'll see what happens, in 2025 if Congress decides to extend this, modify it. The Tax Cuts and Jobs Act has honestly been running on a deficit. They have calculated that if this were to keep going, if it were to be extended, they'd be in a deficit multiple millions, if not billions of dollars. So it isn't something that's sustainable. So, you think about that and what can they do? They can find ways to implement some of these things or modify some of these things where they can try to make things sustainable and not tax people too much. But that was your update. If you have any questions, please feel free to reach out. But it's as always, it's important to stay informed with some of these things, and that's what we're here to help you with. Thanks.